last year, the majority of the gains of the stock market came from the Magnificent Seven stocks. But ever since the start of this year, they have lost their leadership. So are they dead? Is it time to sell? And is China poised for a rebound? Find out in this video. So last year, the S&P 500 gained over 23%. And I'm sure you know by now that the majority of those gains, like more than 80%, came from 7 stocks. These are what we call the Magnificent 7 stocks. Your Amazon, Microsoft, Google, all known as Alphabet, Nvidia, Tesla, Meta, and Apple. And the rest of the gains, like 10%, came from the other 493 stocks in the S&P 500. So why is this so? Because last year there was a combination of a fear of a recession as well as super high interest rates and high inflation. And people went into the Magnificent Seven because they seem to be the safest companies in the market. And they are, because these are the highest quality companies that are immune to high interest rates. That no matter how high interest rates go, it's like, you can't touch me, I'm invincible. Right? Most of them are immune to high interest rates, except Tesla, because to buy cars, a lot of people have to take loans from the bank. So initially, the high interest rate did affect Tesla, and that's why the stock slumped initially. But once you saw interest rates beginning to tick down in the last quarter, Tesla began to rebound back as well. But other companies like your Amazon, your Meta, your Microsoft, your Google, those are truly immune to rising interest rates. So that is why the Magnificent Seven led the market last year. And as you guys know, in my portfolio, I own 6 of the Magnificent Seven. And that's why my portfolio outperformed last year by about an average of 46%. You can see in 2023, last year, Nvidia was the clear outperformer, 246%, led by Meta, and then Tesla. And you can see again that initially it was suffering from the high interest rates, but at the last quarter, it began to catch up with 129%, Amazon 77%, Microsoft 58%, Google 56%, and the worst performer last year, Apple, of the Mag 7, but it was up 54%, versus again the S&P 500, which was up about 23%. But ever since the start of 2024, things have changed, and the Magnificent Seven are no longer pulling the market up. In fact, they are dragging the market down, at least in the first week of January. So take a look at this chart. You can see that this is the performance in the first week of January. So it's just 1 week, but it's interesting to see that the S&P 500 is down 1.8% for the year so far and dragged down by our Magnificent Seven. But what's interesting is the other stocks that were lagging last year, they were not doing well last year, now they're doing well, and now they are actually positive, at least for the first week. For example, look at this ETF, XLU, which is the utilities ETF. So this represents the utility sector. So utilities are usually very boring, very slow growth, but utilities have, outperformed the Magnificent Seven in the first week. Next, XLV, that's healthcare. XLE, energy stocks. XLP, consumer staples, which are your Procter & Gamble, your Pepsi, your low-cost, low-growth essential goods. XLF, financials, especially banks. So all these, which traditionally are low-growth industries, boring industries, they have been outperforming the Magnificent Seven. So what is causing this change in market leadership, and is it a good thing or bad thing? Now, personally, I think that it's actually a good, healthy development for the second year of the bull market. So last year, everyone was just buying the Magnificent Seven because they were very, very safe. They were, again, immune to interest rates, and because of the fear of recession, fear of inflation, high interest rates, people were afraid of the other stocks that were more vulnerable. But this year, now that interest rates are coming down, people are seeing that inflation is coming down, and the economy looks like it's coming in for a soft landing with strong job numbers and the economy is being resilient, people are now feeling more confident to buy those stocks that were left behind, that now look relatively cheap. So in order to buy the stocks, they need cash. So where do they get the cash from? These investors, they get it from the money they put into the Magnificent Seven. So they're selling these 7 stocks to raise cash to buy those laggards, which are the utilities, the healthcare, the energy, the consumer staples, and the financial stocks. And that's why it's really important that in your portfolio, you should have a balanced portfolio in these different sectors. So as you guys know that the majority of my stocks are within consumer discretionary, technology, and consumer services. But at the same time, I also have exposure to healthcare. In fact, I've got quite a lot of healthcare stocks. I've got consumer staple stocks. I've got financial stocks. And so because of that, when temporarily my technology stocks are coming down and communication services are coming down, my healthcare stocks have been doing very well. My consumer staple stocks have been doing very well. And that's the importance of having a balanced portfolio. Now, so this development, is it good overall for the market? I think so, because it shows you that this bull market is now getting broad participation from all the participants in the market. So not just 1 or 2 sectors are in the bull market, everyone is joining the party. So if you think about it, it's kind of like the Magnificent Seven ran ahead, the rest have been left behind. So now the Mag 7 are kind of like resting and giving the rest a chance to catch up, and then they move ahead together. So does this mean that you should sell your Magnificent 7 stocks? Well, it really depends. If you are just doing short-term trading and after a wave up, they're overextended and you want to take profits, sure, you can go ahead and do that. But if you're someone who's investing for the long run and you want to compound your portfolio, like what I'm doing, then would I sell the Magnificent 7? No, I won't. Because yeah, short term, it could still weaken for the next few weeks or even next few months. And I see that as an opportunity to add more shares to these great companies, because long run, they are going to definitely again outperform all the other sectors. They're going to outperform finance, utilities, consumer staples, and healthcare, and so on and so forth. So any weakness is an opportunity to accumulate. But of course, wait for it to drop to strong levels of support and ensure that they get back below valuation levels. And I'm going to show you a few examples in a while. In fact, I told my students about a week ago, before the new year started, I said, if you look at these stocks that did really, really well, after a strong wave up pattern, you should expect a wave down pattern. And I told them, I said that if you need to raise cash, sell to raise cash. And then you could always, accumulate later on when they get to lower levels. But if you don't need the cash, you are putting your savings aside for the long run, then there's no reason to sell. So for me personally, I don't need the cash because every year I put in more cash into the market through my savings. But I did anticipate that there would be a wave down in the first quarter of the year, which is obvious, right? After a wave up, you're going to have a wave down. So what I did was I used a lot of options in order to make some short-term profits, as I expected a short-term pullback in these stocks which I own. So I sold covered call options, and I did what we call cash secured puts and jade lizards, which you guys learned in the options course, and we did share some of this during our black market webinar, right? Okay. However, if you read some of the news, you get some of these bears coming out saying that, oh, you need to, the Magnificent Seven are dead, get rid of them, you're going to sell them, they're going to collapse. And one of those people is Jim Rogers. Every few years, he'll come out and say that the world's going to end, we're all going to die, sell, right? So Jim Rogers came out a week ago. By the way, this guy got famous because he was working with George Soros many, many years ago, right? So a week ago, Jim Rogers says, I see stocks tumbling. I hope to short the Magnificent Seven. Okay, now should you listen to this guy? Right? Well, let's look at his track record, shall we? Now, I remember that the first book I read on commodities was by Jim Rogers, actually. And I read that book about close to like 25 years ago. And for the last 25 years, Jim Rogers has been saying, buy commodities, buy commodities. If you listen to that, you would have died, right? Because if you look at the commodity ETF, DBC, over the last 25 years, you would have lost money, right? And here's a simple chart of the commodity agricultural ETF, ticker symbol RJA. And look at all the times he said to buy commodities, especially agricultural commodities. This was back in '08, right? He said, Jim Rogers said, we are facing an inflation holocaust. I am buying agricultural commodities. Okay. And then over here, he says, lots of growth left for agricultural investors. Went up a bit and then collapsed, right? Jim Rogers says, buy commodities now or you'll hate yourself. Really? But I love myself. I'm like Whitney Houston, okay? We will make money in commodities because of supply shortages. Boom, right? Jim Rogers keeps pumping commodities, especially agriculture. And the more he says buy commodities, the more it goes down. And this is not going down over 1 year or 2 years. This is going down from 2008 all the way to now for the last freaking 25 years. Right? So something's wrong if what you think is going to go up goes down for 25 years. Now, his track record in the stock market is good. I'm just kidding. It's not really good, right? So these were all the times when he came out and he said the market is going to collapse. So over here, 2011, November, he said 100% chance of crisis, worse than 2008. Right there, right? Then 2013, he said, run for the hills. Oh, that's a Iron Maiden song, which I love, by the way. Now I'm doing it. Doing what? Running for the hills. Okay. And then over here in 2014, he said, sell everything and run for your lives. This guy appears to like running a lot, right? He must be very fit, okay? And then in 2017, he said the worst crash in our lifetime is coming. June 8, 2017. Now, if you listen to this guy, okay, you would have missed the S&P 500 going up 406%. So again, be careful when you listen to the predictions of all these prophets of doom, or as you guys know, I like to call them, bear porn stars. Some people ask me, why do you like to pick on these people? Because honestly, I get very pissed off when I see what they say. And the reason I get pissed off is not because of myself, because I don't care about what they say. I make a lot of money. I make millions in the market, as you guys know. But I get pissed off because I know that there are a lot of retail investors who want to build their retirement wealth. And by listening to all this gloom and doom, it causes these people to abandon their investment plans, to stay out of the market because of all this fear that's perpetuated by these people. Or worse, these newbie traders go and short the market thinking they're heroes, and they end up losing their life savings, which is not funny. Which is not funny at all. Because you know that if you invest in great companies, if you invest in a market in the long run, right, it will build your retirement. Right? So anyway, so that's why I like to pick on them, okay? Now, so for me, am I selling my Magnificent 7 stocks, or rather my Magnificent 6? No, I'm not. Because again, in the short term, could they go lower? Yes. In the short term, as we get this rotation out of the Mag 7 into the rest of the sectors. But over the next 3, 5, 10 years, I believe that they will continue to outperform. Because as you guys know, and I shared during the 6-wave webinar event last year, that the next 10 years or more, we are going to have, or we are in a technological revolution that is as or more powerful than the internet software revolution from 1990 to 2020. This was the 5th technological innovation wave that lasted 30 years, where the S&P 500 gained 255%. Over the last 10 years, and that was a 13.51% annualized return. And I expect that in the 6th innovation wave, which we just started, which is going to be transformed totally by artificial intelligence, automation, robotics, the returns in the market are going to be far greater than the last 10 to 30 years, because the impact of AI and automation will drive economic growth and corporate earnings and stock returns. And I want to be invested in the leaders of AI, which are led by the Magnificent 7. Now, again, don't expect the Mag 7 to go up in a straight line every day, every week, every month, every year. No, there will be ups and downs. There will be pullbacks and corrections. And those, to me, are opportunities to keep adding and building one's investment position. Let's take a look at some of their charts. Now, out of the Magnificent 7, yes, there are some of them that are currently overvalued. But there are some of them that are fairly valued, and there are some of them that are actually still cheap. So in my opinion and in my evaluation, based on their normalized free cash flow, I think that Amazon is still undervalued. And my intrinsic value calculation is actually $189. That's my base case valuation. And the more conservative, pessimistic valuation on a lower growth rate is $159 per share. So currently at 145, it is still undervalued. But again, if you take a look at the chart patterns, wave up, wave down, wave up, wave down, wave up, and now it looks like it's waved down slightly, right? Now, again, you can never predict the absolute bottom of a wave down. Like after this wave down, it could be a short pullback and then it waves up again. Or you may even pull back down to this level of support. That's why when I add shares, I never buy at one go. I don't buy all at one support, right? I would add in tranches. So I add a bit. If it retraces lower, I keep adding until it reaches the final support level, and then it continues the wave up pattern. So what I do for my subscribers of the UIP, the Ultimate Investors Playbook, which you can subscribe for, go to insight.piranhaprofits.com and you can subscribe. And every month I will do an update of the intrinsic values of all these great companies and update where are the significant support levels to add shares. And then you get my live buy and sell investment alerts. So once I buy a stock, I sell a stock, I do a screenshot and my subscribers can see it for themselves. Not because I want them to copy me blindly, no, but it's for educational purposes where they can see for themselves live my thought process and my reasoning for why I buy a certain stock and why I buy it at this time. Why do I sell it at this time? And why do I add so many shares, right? What I buy, when I buy, how much I buy, when I sell. I detail all that so people can learn and do it for themselves. All right, so for example, for Amazon, you can see I've got 4 significant support levels. At 143, that is a significant support level because this was a previous swing high resistance that is a significant support level 143. And then another support at 133, 126, and 118. Now, if we get another big crash this year, which I don't foresee, but you never know, right? If we get a big crash, yes, it could come all the way down to this very last support level. But I doubt that's going to happen. But again, in the markets, be prepared for anything, right? So I suspect we're probably going to bottom either at this support right here or at the very most at the second support before the wave up continues. So Amazon, to me, I think it's still undervalued. How about Meta? Meta has run up so much. In fact, Meta was one of the big winners last year. And yes, Meta is undervalued in my valuation. So my intrinsic calculation for Meta is $411. So at $351, still cheap, right? But again, does it mean I'll buy more shares here? No, right? Because again, look at the wave patterns, right? So wave up, wave down, wave up, wave down, wave up, wave down, wave up. I never add on a wave up, never chase the girl. Remember that, never chase the girl. Adam Khoo says never chase the girl. Wait for the girl to come to you and wait at a support level where she runs into your loving arms, right? So when I saw that Meta, for example, at the end of last year, look at that. These are the daily candles where you get a closer look. There we are, right? Wave up, wave down, wave up, right? So once it was at this wave up, I said, high chance is going to wave down. Now, of course, I told my students, if you need cash, you could sell there to raise cash. But if I don't need cash, I'm holding. But I did what I call selling covered call options. I sold covered calls against this position, which I did share in my last video already, right? Yeah. So for Meta, would I add more shares? Well, I do have quite a big position already, but I may be tempted to add more if it waves down to, for example, if it waves down to, for example, 315 or 279, because these are strong support levels. If we get a crash this year, which again, I don't think so, but you never know, then I'll happily add at this level because it'll be damn bloody cheap to ride the wave up for the next couple of years where it's going to really lead the market, right? Let me show you one last example, which is NVIDIA. NVIDIA. Okay, so NVIDIA is one of the Mag 7 that's slightly overvalued. So It depends. Now, when you calculate intrinsic value, it all depends on the growth assumptions, which are quite subjective. So if I take my base case growth valuation, then NVIDIA is worth $414, which at this price is still expensive. Now, if I take the more pessimistic growth projections, then it's worth $290, right? So we call this the valuation range. And ideally, you want to buy it when it's at least within the range, or if you want to be very conservative, then below the range. But sometimes you can never get it that cheap if it's such a game-changing company, right? So for me, I would add below this valuation, but again, at these support levels that I have identified. And would I think that NVIDIA will go all the way back to 220? I doubt it, unless there's a big crash this year, which again, I don't think so, but you never know, right? But I would be happily, grabbing a lot more NVIDIA at, 374 or below, right? But now you can see the trend remains still very strong, but you never know. We could get a sudden sell-off, and that would give a great opportunity to add this great company. Finally, let's talk about China. Is there a potential rebound in Chinese stocks coming? Now, in my last video, I said I'm done with Chinese stocks, and I realized something. There are many people out there who don't actually watch my video to the very end. They just look at the title, they watch the first 3 minutes, and they think they know what I'm talking about. No, dude. If you watch my entire video, you know that I sold one of my China stocks, Tencent, because of the sudden government regulations that came out to ban people spending more on gaming. And I said that's going to structurally affect that company, and I sold my Tencent shares. But I still have my other Chinese stocks. I have Alibaba, I got Ping An Insurance, I've got Chinese ETFs that still make up 4% of my portfolio. And for that, I am not selling. Why? Because the stocks are so bloody cheap, it doesn't make sense to sell. And do I expect a rebound? Yes. When? I don't know, right? And the only reason I expect a rebound is because when things are so bloody cheap, when it's so oversold, obviously there's going to be a rebound. But the question is, will China get back to its former glory of double-digit growth, where long run is going to beat the US? I don't think so, right? So, in other words, when it comes to China, yes, short term, I think there's a high chance it could rebound simply because it's so bloody cheap, right? But in the long run, I don't think it can outperform the US markets. And that's why in the long run, I will exit all my China stocks. So in other words, I'm not selling my China positions except for Tencent, which I sold, but I'm not adding as well, all right? I'm just holding my position. So please be aware and not come to conclusions without watching my video to the very end. In fact, if you watch my video to the end, my last video, you know that my Alibaba, which I hold, is now selling at about 70 Hong Kong dollars, right? And I said that I'm only going to sell Alibaba at about closer to valuation, which is at least $200 to $250, then I will consider getting out of my Alibaba position. So in other words, short term, I believe that Alibaba should be able to double or triple in price to where it fairly should be, right? But long run, I will get out compared to my US companies where I'm going to hold for the very long term, like my Amazon and my Meta and all those things, right? So the question is, in the short term, when would there be a rebound in Chinese stocks, given it's so cheap? Again, no one knows. But I read this interesting article on Bloomberg, which I thought I'd like to comment on. So this came out 2 days ago. It says it's a Chinese stock indicator with a 100% success rate, and it's flashing a buy signal. So what indicator is this? Basically, this is an indicator that compares the difference, the spread between Chinese 10-year government bond yields and the earnings yield of the Chinese stock market, which they are using the CSI 300 as the Chinese index. The CSI 300 are the 300 biggest companies on mainland China. Now, currently, the earnings yield of the Chinese stock market is 8% earnings yield. That's bloody high, right? Now, how do you get the earnings yield? Earnings yield is basically the inverse of the PE ratio. If you take the PE ratio and inverse it, you get the earnings yield, right? So, for example, right now, the US market, the PE ratio is about, if I'm not wrong, about 20 times earnings, right? So if you take 1 divided by 20, the US stock market, the earnings yield is 5%, right? But the Chinese stock market is yielding 8%. So it looks like a better deal in terms of earnings yield, okay? Now, if you buy Chinese bonds, they are giving you a yield from the bond coupon of 2.5%. So in other words, what they're saying is that Chinese stocks are much cheaper than Chinese bonds by 5.5% spread. Now, historically, this happened before in 2008, 2012, 2014, 2018, and 2020. Now, every time that happened in the past, when you get this 5.5% difference, 1 year later, you had 100% probability of the market going up by 92%, by 1%, 120%, 32%. If you take an average, it's a 57% gain from current levels. So what they're saying is that based on this indicator that's showing now, there's a 100% chance the Chinese market will be higher 1 year from now with an average gain of 57%. One of the things that I learned as an investor and as a trader is that whatever some special indicator tells me the market's going to go up or go down, I always have to wait for the price action of the market, the technical analysis, to confirm the reversal before saying that, okay, looks like it's working right now. So if you look at the Chinese charts, so far we don't have a reversal pattern. So if you take a look at the daily candle time frame on the CSI 300, you can see it is still on a downtrend, right? With the 20 EMA below the 40 EMA, the 50 moving average below the 150 moving average. So as long as the moving averages are sloping down, as long as we see lower highs and lower lows, then the downtrend will continue. So what do I want to see before I can confirm and say that, hey, maybe there's a chance the Chinese market could rebound? Well, either I want to see a change in the trend where the 20 EMA, this red line, crosses back above the 40 EMA. That's a short-term trend reversal signal. And eventually the 50 moving average, the blue line, crossing back above the 150 moving average. Then we know that it's a confirmed change in trend. So until then, no, it's still a downtrend. Now, if you look at the weekly candle time frame, you can see it's also on a downtrend as well. I look at multiple time frames. And you can also use, or you can also look for reversal patterns like a double bottom. But we don't have that yet, right? So this was a previous significant swing low. And if we get a parabolic move down with a strong bullish weekly candle closing back above this significant support line and now resistance, then yes, this could signal a reversal. But again, not yet, but I'm watching it carefully. So do I hope that Chinese stocks can rebound? Yes, because remember, I still have a 4% position in the Chinese market. So I want it to rebound. I want it to go a lot higher so that eventually I can get out at much higher levels. Now, if you'd like to join me as well as Bang and Alson live in Singapore at the Marina Bay Sands on the 20th of January, where we'll be sharing in depth our market outlook and analysis and our strategies for 2024, you can click on this link above. The link is also in the description box below this video. And tickets are going for 18 Singapore dollars. That's about 13 US dollars just to cover the cost of the venue. And of course, if you're one of our graduates, do click on the graduate link or email to support@piranhaprofits.com for a special discounted price. So I look forward to seeing you there. Until then, may the markets be with you.